Hello, everyone. Greetings from the channel, Autodidact. We are back in continuation of module -1 for part 3, which is the last part of this section, under the module, Stock Market Investment, a complete course to make from a naive to an expert, where we started the very first module including essentials of stock investing. We extended our learning towards the basic terms and concepts that are commonly used in the stock market. Averaging or averaging down can be understood when an investor buys more of a stock as the price goes down. This makes it so your average purchase price decreases. You might use this strategy if you believe that the general consensus about a company is wrong, so you expect the stock price to rebound later. For example, you bought 100 shares of Z Entertainment at Rs 350, now when the price has fallen to Rs 300. You will buy more. After this, your average price of the share will come down to Rs 325. Now, if we talk about bourse, this stock market term is a little murky. Technically, it's just another name for the stock market and originates from a house in which wealthy men gather to trade shares. However, when you hear it in today's conversations about the stock market, it usually either refers to the Paris Stock Exchange or to a non-US stock exchange. Next term is dividend, a portion of a company's earnings that is paid to shareholders, or people that own the company's stock, on a quarterly or annual basis. The amount of earnings distributed as dividends is usually determined by the board of directors and divided by the number of shares, but preferred stock often has guaranteed dividends. Not all companies pay dividends. For instance, if you trade penny stocks, you're likely not after dividends. You can understand like this: let's say your company earned Rs 100 as profit. It will keep Rs 50 with itself for further investment, and will invest rest Rs 50 among its shareholders. If the company has 25 shareholders, each shareholder will get Rs 2 as dividend. Talking about execution, there are plenty of offers for buying and selling of shares. But, due to the spread, all of them are not traded. When an order to buy or sell has been completed, the trader has executed the transaction. If you put in an order to sell 100 shares, the execution of order means that all 100 shares have been sold. Quote is a share is the information on a stock's latest trading price. This price tells you its quote. A stock quote is the price of a stock as quoted on an exchange. A basic quote for a specific stock provides information, such as its bid and ask price, last traded price, and volume traded. This is sometimes delayed by 20 minutes unless you're using an actual broker trading platform. The yield of share often refers to the measure of the return on an investment that is received from the payment of a dividend. Simply put, yield refers to the earnings generated and realized on an investment over a particular period of time. It's expressed as a percentage based on the invested amount, current market value, or face value of the security. It includes the interest earned or dividends received from holding a particular security. This is determined by dividing the annual dividend amount by the price paid for the stock. For example, if you bought stock for $40 per share and it pays a $1 per year dividend, you have a yield of 2.5%. Moreover, when it comes to an annual report, it is a report prepared by a company that is intended to impress shareholders. It contains tons of information about the company, from its cash flow to its management strategy. When you read an annual report, you're judging the company's solvency and financial situation. Usually, it is in the form of a balance sheet holding a balance between the assets and the liabilities of the company. While trading, we cannot transact a stock without a broker. This broker is a person or a company who buys or sells an investment for you in exchange for a fee or a commission. There was a time when brokers used to give you a set of papers to hand over your own stocks. That process was cumbersome and time-taking. Nowadays, all the delivered shares are kept in a depository in electronic form. Like, you own a locker in a bank, similarly, your shares are kept in this depository. This is called the materialization of stock. Understanding leverage is very interesting, though I'm not a fan of leverage, but it's good for you to know this stock market term. When you use leverage, you borrow shares in a stock from your broker with the goal of increasing your profit. If you borrow shares and sell them all at a higher price point, you return the shares and keep the difference. It's the dangerous game that I urge you to avoid playing. Arbitrage refers to buying and selling the same security on different markets and at different price points. For instance, if stock is trading at $10 on one market and $10.50 on another, the trader could buy X shares for $10 and sell them for $10.50 on the other market, pocketing the difference. So friends, this is all for now. If you have any other topic to be included, please mention in the comment section. I will be back with another section of your learning soon. Please subscribe to the channel to get regular updates.